Hello, and welcome to another episode of Money Talks Finance for All. I'm your host, Alex, and as always, I'm here to help you navigate the world of personal finance with clear, actionable advice that you can use today. Whether you're a seasoned investor or just starting your financial journey, this episode is for you. Today, we're diving into an essential topic for any investor: diversification. You've probably heard the phrase, "don't put all your eggs in one basket," and that's exactly what we'll be exploring. I'll share the top 5 strategies for diversifying your portfolio to help you reduce risk and optimize your returns. So grab your coffee, sit back, and let's jump right in. First, let's talk about why diversification is so important. At its core, diversification is about spreading your investments across different assets to reduce risk. No one can predict the future, not even the smartest financial experts. By diversifying, you ensure that one bad investment doesn't derail your entire financial plan. Imagine this. You invest all your money in a single stock because it's been performing well. Then, due to unforeseen circumstances, the company faces a major downturn. Without diversification, you're at the mercy of that single investment. But with a diversified portfolio, losses in one area can be offset by gains in another. In short, diversification is your financial safety net. Now that we've established its importance, let's get into the top 5 strategies to diversify your portfolio. The first and most fundamental strategy is diversifying across asset classes. This means investing in a mix of stocks, bonds, real estate, commodities, and even cash or cash equivalents. Stocks are great for growth, but they're also volatile. Bonds, on the other hand, provide stability and steady income. Real estate can offer both income and appreciation, while commodities like gold and oil serve as a hedge against inflation. A well-balanced portfolio might look like this: 60% stocks, 30% bonds, and 10% in alternative investments like real estate or commodities. The exact mix depends on your financial goals, risk tolerance, and time horizon. Next, it's crucial to diversify within each asset class. Let's take stocks as an example. Instead of investing all your money in one company or sector, spread your investments across different industries, company sizes, and geographic regions. For instance, you might allocate 40% to U.S. large-cap stocks, 30% to international stocks, 20% to small-cap stocks, and 10% to emerging markets. This way, if one sector or region underperforms, your portfolio is cushioned by the others. The same principle applies to bonds. Consider a mix of government, corporate, and municipal bonds with varying maturities and credit qualities. Strategy 3 is all about rebalancing your portfolio regularly. Over time, your investments will grow at different rates, which can throw your original asset allocation out of balance. For example, if stocks perform well, they might end up representing a larger portion of your portfolio than you initially intended. Rebalancing involves selling some of the overperforming assets and buying more of the underperforming ones to restore your desired allocation. This disciplined approach ensures that you're consistently buying low and selling high, a cornerstone of smart investing. Aim to rebalance at least once a year or whenever your asset allocation deviates significantly from your target. The fourth strategy is to consider using index funds and exchange-traded funds, or ETFs, for diversification. These are fantastic tools because they provide instant exposure to a broad range of assets at a low cost. For example, a total market index fund allows you to invest in hundreds or even thousands of companies with a single purchase. Similarly, sector-specific ETFs let you target particular industries without the risk of individual stock picking. The beauty of index funds and ETFs is their simplicity and efficiency. They're perfect for investors who want to diversify, but don't have the time or expertise to research individual investments. Finally, the fifth strategy might surprise you. Invest in yourself. While this isn't a traditional form of portfolio diversification, it's one of the most impactful. Enhancing your skills, education, and knowledge can significantly increase your earning potential and open new doors for income streams. For example, learning about personal finance or acquiring skills in a high-demand field can lead to career advancement or entrepreneurial opportunities. Think of this as diversifying your human capital, the most valuable asset you have. Remember, the more you invest in yourself, the more resilient and adaptable you become, which is invaluable in an ever-changing financial landscape. Before we wrap up, let's quickly touch on some common diversification mistakes to avoid. 1. Over-diversification. Spreading your investments too thin can dilute your returns and make your portfolio hard to manage. Stick to a balanced approach. 2. Ignoring correlation. Diversification isn't just about quantity, it's about quality. Ensure your investments are truly diversified and not moving in the same direction during market swings. 3. Neglecting global opportunities. Don't limit yourself to domestic markets. International investments can provide exposure to growth opportunities you might miss otherwise. 4. Forgetting to rebalance. As we discussed earlier, rebalancing is key to maintaining your desired risk level. So there you have it, the top 5 strategies for diversifying your portfolio. 1. Diversify across asset classes. 2. Diversify within asset classes. 3. Rebalance regularly. 4. Use index funds and ETFs. 5. Invest in yourself. Remember, diversification is not about eliminating risk. It's about managing it. By implementing these strategies, you can create a portfolio that's resilient, balanced, and aligned with your financial goals. If you enjoyed today's episode, please subscribe to Money Talks, Finance for All, and share it with a friend who could benefit. And don't forget to follow us on social media for more tips and updates. Until next time, stay focused, stay disciplined, and keep working toward financial freedom. Thanks for tuning in